What's up, ladies and gentlemen? This is Andrew here with Spark Finance. And what are dividends in the terms of investing? And what the heck are you supposed to do with them when you receive them? That's what we're going to be going into in the video today. To start off with, when you are stock investing, you are buying shares of ownership or stock in a company. It's like if you are buying a company, a retail chain or a factory outlet on Main Street, and this version is a little bit more widely distributed. There are a lot of other investors instead of maybe just you as an individual or a couple of individuals teamed together to buy your local franchise. Just like when you buy a company, the reason you are doing this is to generate some kind of income for yourself. You want to get that passive income that everybody loves, right? So by being a shareholder or stockholder of a company that pays dividends, that entitles you to the payment of a portion of the profits of the company to you in the form of a dividend. That is very important. That's what a lot of people are doing now. There's a big trend now where people are going into this passive dividend investing. So the board of directors of a company usually sets a specific rate that will be paid out in terms of the dividend. And when that's set by them, you can see that online on any kind of financial news website, and you can see what a stock will pay as its dividend. The dividend yield is the payout as a percentage of the company's current stock price. So that is basically like a yield like you would have on a bond. And as the price goes up on the stock, the yield goes down. It acts inversely. If the stock price goes down, the yield will go up. And a company that pays out the set dollar amount, that is called the actual dividend rate. So that's the dollar amount that you get for each share of stock you own. That could be $1, that could be 20 cents a share. But for every share you own, you're going to get a payout of that. Then a lot of these companies now and a lot of mobile apps that have brokerages or online brokerages, they have the ability to reinvest dividends, right? So this is a great way for new investors to get into the marketplace and simply automate everything and have the money that they receive in dividends automatically be reinvested into the company's stock. So let's say you have a company that has a $100 share price for one share of stock, right? Let's say they pay you out dividends of $250 a year because of the amount of shares that you own. So if you're auto purchasing or reinvesting the dividends, when you get that $250, you would get 2 shares of stock for $100 each, and that extra $50, that would be held until the next time you get a dividend payment, and it would just keep going towards an additional payment until you have enough for one more share of the company. So in that way, it just keeps kind of snowballing to a bigger and bigger portion or holding in the company, and hopefully then paying out more dividends because you own more shares. The big question is, should you really be reinvesting your dividends? Is that always the best option? Is that the best case in every scenario? Let's actually go over the specific scenarios where that is looking like the best option for you. To start off with, if you're taking a very passive approach, if you're doing index investing, you have a S&P 500 or Russell 2000 index fund or a specific ETF that just pays out a dividend, you don't want to be looking at it every month or week or year or whatever, then it does make sense to go and reinvest. By all means, just go and auto reinvest all of those dividends, and then you don't have to worry about going in there and make sure your money is being utilized to its full potential. That's very important there. And since most brokerages have this option, you can just sign up for it and it will automatically do it for you. Another time it would be a good choice is if you don't have that much money invested in the company paying the dividends, so that when you get that payout, maybe it's not even enough to buy any shares of stock, or maybe it's only buy a few shares. It's not really significant there when each quarter you can only buy 3 shares of stock, you're only getting a couple $100 in dividends or something. It's not really a significant amount. Just automatically reinvest that so you don't have to worry about it. Keep in mind, some companies, they pay out their dividends 4 times a year, once for each quarter. That's the normal. But then there's also some that pay out monthly dividends, or some that pay only once per annum or once per year. There's a couple different options there, and you have to make sure when you're purchasing the stock that you know what your company is doing. So the alternatives to just reinvesting the dividends automatically. One is you could just take that money that you earn and you could pocket that cash, right? So you could actually take that, you can help it for your living expenses, you can still make a capital appreciation in the stock price. And then the rest of those dividends you're taking, putting in your pocket and using for your everyday expenses. You can help it with your living expenses, right? So that sounds pretty good. It's a good way to do that. Now, a lot of people that take this approach, they're usually wealthy already, and it's more about preservation of capital rather than kind of growing the amount of capital that they have. And that's why they can just take those dividends and either live off of them or help out their monthly incomes. Unfortunately, it's like for dividends which yield 5% or less, you could be looking at having $1 million in an account to be able to do that. So it is not always the best approach. Right now, in general, dividends do make sense though, because interest rates are at a 200-year low. Deutsche Bank came out with a report that even said this. So this is very important. There's not really anywhere else where you can get the yield like you can get in stocks that offer dividends. You can't go and buy bonds that'll have good yields and they'll be secure. So one thing you have to look at is inflation. If inflation ticks up here, if it kicks up, then you have to look at the yield of your company and make sure that the yield is higher than the inflation rate. Otherwise, you are losing money. Another thing with this, a lot of companies don't even pay dividends. Why are they actually important? Let's take a look at that. Well, looking at the historical precedents here, if you look at the period from 1930 to today, 42% of the S&P 500's return has been actually from dividends. Now, this can vary widely from time frame to time frame here. If you look from 1980 to 2019, I believe it was around 75% of the S&P 500's total return was from dividends. But most importantly here, it is always a significant percentage of the overall return from the dividends, usually above 15%. So if you are into individual investing and you want to invest in individual stocks rather than an index, there is another method that some investors use when deciding what to do with these dividend amounts that they are receiving. When you reinvest the dividend, you don't really have control at the price point that you are repurchasing the additional shares of the host company, right? So the shares are being accumulated and you have no control. Are you buying it when it's expensive? It could be at a 52-year high and you could be buying it at that point. You want to buy at the 52-year low when you're getting it at the cheapest amount, or you want to get it when the valuation is not considered expensive on the stock. You're also enforced to reinvest the money in the same company rather than take advantage of opportunities you see in the marketplace, maybe in other companies, right? You have to reinvest it in that same company. So instead, if you store the dividend in your account and you make a lot of money on dividends, you can save up a nice little ball of money there until a sell-off in that stock that you own, or maybe another stock that you would like to purchase that pays dividends, and then you can jump in at the opportune moment there. Now, if you look at some of the charts of how your money will grow if you're able to miss the worst trading days in a stock or index in a year rather than staying in all the time or purchasing at the low instead of the highs, the returns are really significantly different there. And that's important to take into account in what individual investors look at when they're trying this approach. This approach, of course, takes a lot of judgment, but the returns can be significantly higher than simply auto reinvesting. If you're doing everything passively, you are not going to have the highest returns. The two main factors here would be, do you accumulate a large amount of dividends so that you'd be able to put that into another stock? And are you good at actually picking stocks at good prices? If you want to leave that up to the professionals, then you don't take this approach. And if you have a small amount of money total in dividends, you have a couple $100, you're not really going to be able to make big purchases that would affect the overall bigger picture. The easier approach is just to reinvest the dividends automatically in those cases, right? If you don't want this extremely active approach. Now, some things to look at with dividends in general. Dividends are scary if they are not paid out of the company's earnings. Watch out for yields that are higher if they are higher than the average dividend yield for that industry or sector. So if a particular sector is yielding, say, 5%, you see a stock is yielding 10%, that is outside the normal range, and it usually means the dividend will soon be cut, the company's earnings are going to start going down, they have to cut the dividend, or the company is actually financing that dividend through debt. So you also have to look at the balance sheet of these companies it's important to look at kind of the financial statements and make sure that the company is not taking on additional debt just to pay the dividend, just to pay out money to shareholders as a reward. Some of these companies do that through offering debt, which is not a good sign. You want them to be able to pay the dividend through their own profits, through their own earnings. On the good side here, dividends actually create a bit of a floor in the price of a stock. So if a stock price is selling off for whatever reason, there could be a news headline or something just came out, some change in the environment or nature or whatever, the yield actually goes up on the stock when the price comes down. A lot of people talk about this, buying it when something gets beat up. They can go and purchase something that offers a high yield, and then for however many years you hold it, you get to maintain that higher yield. So that is really important there, and a lot of companies that don't have that kind of floor price when they pay out a dividend, that's when all the value investors come in and they scoop up the stock. They won't let it go to, it's not going to go to zero like some of these other companies that don't have that floor from the dividend. That's another thing to think about there. And then also a lot of these companies, they will increase their dividends over time. And you can take advantage of that here as you're kind of reinvesting or you're choosing companies that have a strong track record of raising dividends over time. So depending on what your goals are here, you really need to look at your overall kind of investing picture, what you're trying to do for yourself. And if you should be focusing on dividend companies or you should be focusing on other areas. If you're young and you're just starting out in investing, you should really not be focusing on dividend companies. You should be focusing on growth companies. Growth is what you want. You want your capital to increase as much as possible, as fast as possible. Dividends are more for kind of more mature accounts where people are not looking for as much growth. A lot of the companies that pay high dividends themselves are mature companies, and they don't have the same kind of innovation and fast growth that they have as a lot of these younger growing companies, the innovative companies. Instead of reinvesting the money back into the company, they are instead paying it out as a type of a reward to the shareholders. I mean, they want to reward the owners of the business. So on one level, that's good. But one of the biggest problems with dividends is that they're actually double taxed. This is a big thing here. So the profits are taxed when the corporation earns the money that they earn, right? They're taxed once. Then when they go to pay that money out to individual investors in the company, that is taxed again on the individual level by the people that are receiving that dividend income, and that's taxed as income there. So it's actually taxed twice here. The money, if it was just reused on the company's projects, if they paid that tax once when they earned it and then just reinvested it on what they were doing as a business, they wouldn't have to have that second tax go out and more money go to taxes rather than to the company's value or to individuals. This is one of the reasons why people like Warren Buffett are really against kind of paying out dividends in his own company, like Berkshire Hathaway. The company, by reinvesting the money into growing its business, should be able to get a return on equity of, say, 10 to 15% a year. That is really significant and much higher than the average dividends that are paid out by companies. It is using the money less effectively when you pay out the dividend and you pay more in taxes. Do you think Berkshire Hathaway would have made so much money for their investors if they had paid out dividends instead of just reinvesting the money in the company and watching the market cap and the value of the company just keep growing and growing and growing? One of the rules of investing still applies when you are dealing with dividend investing, right? Make sure that you always have your money working for you. You don't want to just leave this money sitting in an account earning almost no interest. A low interest bearing account is not going to help you at all. So whatever your approach is, whether you're reinvesting it, you're taking some of that money to spend for your daily living needs, or if you want to go and find opportunities in the marketplace to put it to work, make sure that you put the money to work. If you want the simplest solution, simply reinvest the proceeds automatically back into the stock and watch your money compound over the long term. With all of that, thank you for watching, everybody. This is Spark Finance. Stay tuned if you want to learn more about, business, personal finance, investing, and economics. There'll be more videos on the way. Have a good one.